The Aussie dollar has charged ahead for the last few years, and it's no secret its bull run has hurt many businesses. The last 2 months have seen the dollar shed nearly 5% of its value, but pundits say there's little hope of long-term relief. Andrew Robertson has been investigating.
Businesses all over Australia have been sweating on the dollar's bubble bursting. The big question is, are we seeing it with the latest downward move?
But it would take a pretty calamitous change from the way things appear at the moment to get the currency into the low 90s or the mid 80s.
The Australian dollar is one of the most volatile currencies in the world, and since the beginning of March it shed 5 US cents from its high of $1.08. However, in January it gained 6 US cents, which means it's actually higher now than the start of the year. Perpetual's Matt Sherwood believes the recent fall will continue, but not dramatically.
You'd have to see a rapid deterioration in the Chinese economy and in the US economy, and a re-emergence of the major stresses in European sovereign debt problems to get it towards that level. But even then, given all the stresses that we saw last year, the Aussie dollar only got down to 96.
St George Bank's Hans Kunnan also sees the dollar falling but staying above parity. The key, of course, is China and its seemingly insatiable demand for Australian iron ore and coal. Chinese economic growth is slowing though, but Hans Kunnan rejects suggestions there'll be a hard landing which would take the Australian dollar with it.
They went through a hard landing back in the mid-90s when their unemployment rate went up, their growth really slowed, and that was a shock to their system. They don't like those sort of shocks. They have the financial firepower to keep their economy growing at now the pace of 7.5%.
And while a rapidly slowing Chinese economy will push the Australian dollar down, it's the reverse when it comes to the US, where stronger economic performance bringing the prospect of rising interest rates would also be negative for the dollar. But as Commonwealth Bank currency strategist Joseph Capurso points out, there's little chance of that at the moment.
Ben Bernanke, the head of the US Federal Reserve, every time he speaks, he downplays the recovery in the US labour market. And he's the man in charge of the interest rate lever, and he's in no mood to tighten monetary policy, despite what the market's pricing.
As for Australian interest rates, which also have an impact on the dollar, the Reserve Bank has virtually locked itself into cutting them next month.
The RBA pricing for a rate cut is already in the Aussie dollar. In fact, I think the market is too bearish on the Aussie economy, expecting another follow-up interest rate cut later in the year. I don't think that's going to happen.
Which means if the experts the ABC spoke to are right, the Australian dollar will be staying at elevated levels at least for the foreseeable future.